Thank you for joining me. I want to talk a little bit today about the Dodd-Frank Act, which was passed in the aftermath of the Great Recession of 2008. In capitalist countries, especially in the United States, it's typical for there to be large sweeping pieces of federal legislation passed in the aftermath of recessions and other financial crises so as to solve the problems that just occurred. Often government regulation is backwards looking. In fact, almost always it is, and it attempts to ensure that those kinds of problems that just happened don't happen again. And by that metric, Dodd-Frank has been very successful. Dodd-Frank basically targeted some of the problems that brought about the subprime mortgage crisis and the subsequent Great Recession, including most especially the ethically risky behaviors that had been engaged in by predatory lenders, by bankers, and by mortgage originators who targeted persons who didn't understand finances very well and who were persuaded to take out mortgages that were beyond their means. Dodd-Frank has a number of other provisions as well, mostly having to do with stability in the financial system. And in fact, that's actually the first part of Dodd-Frank that I just want to briefly mention. It is the establishment of the Financial Stability Oversight Council, or FSOC, FSOC. The Financial Stability Oversight Council was tasked in the aftermath of the Great Recession with evaluating large financial institutions like the country's major banks and other kinds of financial practices. Smaller institutions were targeted sometimes as well. And the point was to identify places where there were weaknesses in the economic system, places where institutions might be engaging in behaviors which could bring about what might be called financial contagion, that is, defaults on loans that can cause other institutions to default on their loans, and liquidity can dry up in such situations very quickly, and so on and so forth. Okay. The establishment of the FSOC was essential to the development of greater government oversight in the aftermath of the Great Recession of the aspects of the financial system that brought about the risky behaviors in the first place. Also, an essential part of Dodd-Frank was the mortgage protection part, where the predatory kinds of mortgages that pardon me, the banking institutions, many of them at least, had engaged in previously, were banned, and other kinds of mortgages were encouraged. In the aftermath of Dodd-Frank, lenders had to ascertain that borrowers met a standard duty of care, which included several provisions for the ability of the borrower to repay the loan in a timely manner, and the ability of the borrower's income to cover the loan by a certain percentage amount. The government also tried to incentivize privileged mortgages, qualified mortgages, in the aftermath of Dodd-Frank. These included especially fixed-rate mortgages of the 30-year variety, although 15-year mortgages were privileged as well, because these were standardized mortgages. They were easy for mortgage borrowers to understand, and the government wanted to help protect borrowers from themselves and keep them from falling into the kinds of financial traps that had been laid for them prior to the Great Recession. Also essential to Dodd-Frank was the strengthening of FDIC provisions. So if you deposit money in a banking account in the United States, it is guaranteed up to a certain amount by the FDIC, and the government wanted to strengthen that so that there would be continued confidence in the banking system if and when other crises arose. When the way banking works in the United States is by means of something called fractional reserve. Banking institutions have a loan book that they run. That's where they make their real money, and they make those loans on the basis of deposits which their customers entrust in the hands of the bank. So when you deposit money in a savings or checking account, they then take that money, and not yours maybe individually, but in aggregate they take the deposits, and then they run loan books on the basis of those deposits. They loan the money out to borrowers for car loans or housing loans or other kinds of personal loans, and they use your deposits to do so. Government wanted, after Dodd-Frank, to encourage depositors to keep their money in the banks. When people get scared, they sometimes withdraw money from institutions that look as though they might be failing. Government wanted to ensure that depositors kept their money in the banks going forward, and so they strengthened FDIC provisions to guarantee people's savings and checking accounts and the money that they had deposited in such accounts. Government also increased several other provisions, including whistleblower provisions. A lot of people leading up to the Great Recession spotted some of the risky behaviors and problems, wanted to blow the whistle, but were afraid to do so because often in corporate culture there is retaliation against persons who out the risky behaviors or nefarious behaviors of management. The government wanted to protect whistleblowers because it was ascertained that a number of these whistleblowers could have, if they had been able to come forward, could have solved the problems that eventually arose or helped the government and others solve those problems. If they had been guaranteed that there were protections to help keep them from being outed or retaliated against. So the government increased compensation for whistleblowers and also increased legal protections, anonymity, and so forth, so that whistleblowers could have increasing confidence that their insights would be heard. Finally, there were a variety of other provisions which Dodd-Frank instituted, including management, provisions involving management, C-suite executives, boards of directors, trying to rein in some of their reckless behaviors. Many management types in the lead up to the Great Recession had set up their companies, their whole companies, so as to compensate themselves generously by means of stock options and other kinds of package materials. And so Dodd-Frank stipulated that for public corporations at least there had to be stockholder votes for all forms of management compensation. And it instituted, that's just one example, it instituted a variety of other checks and balances to ensure that management was being kept in its place. All in all, Dodd-Frank dramatically increased the role of the government in the regulation of business in the United States, and it substantially impacted the financial industry from top to bottom. I neglected to mention one important part of Dodd-Frank, and that is the establishment of the Bureau of Consumer Financial Protection. The BCFP, Bureau of Consumer Financial Protection, was developed in order to protect mom and pop from themselves. Mom and pop got into a lot of financial difficulty leading up to the Great Recession because they didn't know how to handle the instruments that they were being sold and offered by financial professionals. The BCFP was intended to prevent predatory practices of this kind, and so it made a lot of financial instruments off limits to mom and pop by means of various hoops that it's difficult for ordinary persons to jump through. And it did this in the name of protecting ordinary citizens from themselves. That was controversial because it was said by critics that in keeping ordinary persons from having access to some of these financial instruments, actually the government was limiting their financial prospects and making it more difficult for them to be able to earn their way out, increase their financial well-being, and earn their way out of any difficult socioeconomic circumstances that they were in. At any rate, though, in the name of protecting them from their own bad choices, the government did institute a large number of oversights to prevent banks and other lenders from being able to sell them instruments that they didn't understand or know how to use very well. There are a variety of other aspects of Dodd-Frank. That's just touching the surface, but it is the most important aspect, I think, and it's impacted the American financial industry to the present day.